Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360 program. Nice to have you. Thanks for tuning in to our program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m. and Wednesday and Thursday at 2 p.m. Recently expanded by popular demand, along with their co-host Joe Kuchera, Laurie Graymont for those other segments. If you can't make the live show, you can catch your podcast on re360radio.com. And you can catch my programs on TomWilsonProperties.com or on iTunes. Just put in Wilson Investment Properties or Tom K. Wilson, and you will pull up the podcast with the different segment titles and select the ones you want to hear more about. We are going to, today we're going to handle some frequently asked questions. We get lots of folks asking very good questions about investing, and we're glad to field them, and we don't always cover all of these aspects in our normal programs with our guests, so we're going to address a lot of those today, and hopefully a lot of those questions will be ones that you maybe want to ask or have asked yourself. You can go to TomWilsonProperties.com and request a newsletter on economics and real estate that's published once a week. Written by our economist Howard Blum, who was on a recent program. And you can look for that also, if you go to the podcast, look for the Howard Blum Economics Update. But you can get a weekly snapshot. He spends hours and hours looking through all of the economic news that's going on in the country and boils it down to a nice couple of minute read, one-page read. And if you ask for that, we're glad to send that to you. Your name doesn't, email doesn't go anywhere else, and there's no obligation. We also have a report that you can ask for on how to select the best metro and product, and we take you through the methodology of how to go about that. If you have questions, suggestions for topics, or guests, let us know that. And if you'd like a free consultation on taking a look at your plans to invest or expand your plans in real estate, we'd be glad to take a look and give you suggestions on what we think you should or should not do in order to make that a stronger portfolio. So we're going to start today with some questions that we get all the time and that specific listeners have written in and asked for. And of course, the one we're getting a lot today is, have I missed a window of opportunity? Is it still a good time to invest? Well, I would say that you need to understand that the market is really thousands of submarkets, and you can't give a categorical yes or no to that question. The answer is yes, it's a wonderful time and still a great window of opportunity to invest as long as you're investing in the right location and the right product and have the right team to do that. So what are the factors that are very important or the most important in figuring out where to do that? Well, number one, you got to decide what your objective is. Now, most of our listeners and most of the people that come to us are looking for retirement cash-on-cash return, or they're looking for some cash-on-cash return now and enough to retire on later on. And that's what they want to do. So I'd say one of the big mistakes that people make is somebody will tell them, just go buy this product. They feel comfortable because they can drive to it. if you look at the best day and the best year and the best results, it might almost cash flow, but it really doesn't. On the average, it really has negative cash flow when you take into account that maybe the property is older and it's got some repairs and maintenance and so forth. But they buy it because their cousin said to, or the one agent they met said to. And in the back of their mind, they're saying, well, I expect this price to be quite a bit higher in a few years, and even if it doesn't cash flow much, I'll make a lot on the appreciation. Well, indeed, in the last run-up, there were a lot of folks that made those gambles, and fortunately or unfortunately, some of them did okay, did pretty well. But to assume that that's going to repeat, and that's a model that's predictable, is not a very good sound policy. So I would say the first thing you want to do is go invest in a product that has cash flow today. You want to invest in a metro that has a growing population, and the primary thing that grows a population is increased jobs. And I like to find metros that have more than one major economic sector. If you go to a town that just has an oil company, or a town that just has one dominant company like a FedEx or like a Hewlett Packard, or one dominant company, if you're at risk of that one sector not doing well at some time in the future. So I like metropolitan areas that are broad-based in their economy, that attract business and are growing in jobs, and that therefore have people coming in to fill those jobs with a growing population, a prediction and a reason and fundamental reasons that will continue long term, and that there's not an overbuilding of properties. Now, certainly as we're recording this session in 2014, we certainly are coming out of a significant recession and real estate drop that we had, and part of that was impacted by overbuilding. And certainly at this stage of the game, or at this point, there's I would say in general there's not overbuilding, so that's not a significant factor right now. I'd say there are a lot of builders who would like to build if they could get money, but tight money is holding them back. So it's no secret for listeners who know us or know our business. Wilson Investment Properties' favorite city is Dallas-Fort Worth, and we like actually any city in Texas. Are they the only places that you can invest and make money? No, but I think they exemplify or are iconic in the kinds of cities that we like. Having a metro with 24 Fortune 500 companies, that has a state that has a employment growth which is double that of California in spite of being a smaller population, inward migration that has an increased demand for housing and therefore pushes the rents up and pushes the prices up, and the demand for more housing is the kind of place that I want to invest in, since it has a good cash flow formula that works. And how you come up with a cash flow rule of thumb to start with is having a rent ratio of 1% or greater. So what is that? You take the rent, say it's $1,000, and the price of the house, say it's $100,000. Yes, these are actually achievable in many parts of the country, and some parts of California we're kind of coming out of that now. But if you have $1,000 rent and a $100,000 property, that's a 1% per month of the value of the property, and that's the magic number. With a 20% or more down payment, you will generally cash flow. So let's face it, all of your income in a single-family home investment is the income itself, and your expense is dominantly what your debt is. And so therefore, since the debt is tied as a percent of the house, if you take the price of that house and you divide that into the rent, that'll give you your rule of thumb. So you always want to look for at least 1% or greater. So Texas cities, except for Austin and Dallas-Fort Worth in particular, have all of those factors, and that's why I like to invest there. So for whatever reason you don't want to do Texas, you want to do somewhere else, that's fine. Just apply those factors. How many different companies are there, businesses? Are they growing? What's the population growth? What's the immigration? What's the fundamentals of those businesses and of the basis of that growth? Does it look like it will continue for a long time? How much is that inward migration compared to other places? And can you buy properties that are good quality properties in good neighborhoods with low crime and good schools that are in the mainstream of where the shopping is and where the employers are? That will give you a rent ratio of 1% or greater. So any city that meets those that criteria and breadth of economy, breadth of different kinds of businesses, that will be a kind of place that you want to look at very carefully, and it has high potential of being a good long-term investment property. But you want to make sure that it's cash flowing immediately, not just with promises that that'll probably someday, and you're secretly hoping that you make a lot of money on appreciation. If you want to gamble a portion of your portfolio on places that you think have a higher chance of having a high appreciation, and they really will cash flow or at least break even for now, then that's okay as long as you know that's what you're doing. But just recognize that part of your portfolio is a bit of a gamble, and don't count on that as being a significant part of your future retirement income. So this is Tom Wilson on Real Estate 360. We're on KDOW 1220 AM, and we're talking today about fundamental questions that many investors who are relatively new are asking about real estate investing, and this particular time of real estate investing, which has certainly been a very, very dynamic one with many changes, which naturally bring up new questions. When you get back, we'll go to a lot of those other questions and give you some quick responses.
For more information on today's program, visit re360radio.com. That's re360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit re360radio.com. That's re360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks for being with us. We are today discussing a lot of questions, frequently asked questions about real estate investing, and we hope that some of them that we cover today are ones that you have as well, that you've either asked or have been meaning to ask, and we can get you some better ideas about that. So investing, as we're recording this in 2014, they're near the beginning, and we have a dynamic of a lot of the country coming out of the real estate recession, but many parts of the country probably not having reached its peak yet. Do I still invest in real estate? I think the answer that I have is yes, because I think it's a lot lower risk and higher potential continued climb than, say, securities, which I feel, and economists that we talk to and that we've had on the program even recently feel that securities are are at risk now, at their peak, much more so than real estate. But if you're looking for real estate for retirement, you certainly want to have ones that not just potentially have cash flow in the future, but you want to get product that cash flows right now. What kind of property do you buy? Houses, duplexes, multifam, commercial? Well, certainly near the beginning, you want to either go with smaller products that you can get loans on, or if you want to go into larger products such as multifam, that's okay, but unless you have experience with that, number one, it's very difficult to get a loan, or at least one with decent terms, and number two, you're much better off having an experienced partner in that, and that is certainly something that you can do. So in general, if you don't want to go that route, but you are thinking either small multifam or houses or duplexes, I still like houses because they tend to appreciate more because they are their values are driven up by the owner-occupant demand, not just by rents. They're more liquid, easier to get loans on, easier to take care of, less variables, simpler, I think. And you can get a portfolio of those houses and spread them around to different areas and broaden your risk. I get people ask if they want to, should I flip or rehab? You can certainly do that, but I will say that products are in fairly short supply. Getting enough margin in order for that to work is difficult, even when you're experienced. If you want to do it, I suggest, again, getting hooked up with a partner that you can bring something to the party on. Either you have some experience in and you're willing to manage the project, or you have money and you want to be passive and you want somebody that's already experienced at it. Don't just go out there on your own and think it's easy to just replicate all the flip your house shows that you see on TV. I have flipped many houses, probably about 350 of them at this stage of the game, and it is still a difficult business, and it's gotten more difficult in recent years. More people have jumped on the bandwagon of trying to do it at the same time that the supply of product has been reduced, and many of those overpay for the product, have no margin left. They have to sell at top dollar in order to try to even break even, and they have unrealistic expectations. So be very careful about that. When's the right time to buy real estate? Well, you certainly, if you've bought for cash flow, it doesn't make a lot of difference if that house price goes up or down. You'll still get your cash flow and your objectives toward retirement. But certainly if you have two areas to invest in, you'd prefer to be in one that's going to go up in value. So there are about three primary variables that help indicate when that is going to happen. And we'll talk about that when we get back from this break and talk about some other, many other factors as well. So this is Tom Wilson with Real Estate 360. We're on KDOW 1220 AM, Wall Street Business Network. And as soon as we get back, we're going to chat about not only factors that affect when to buy, but whether or not you should have an entity. What are the times that you invest, and how you go about finding a team that will help you invest, and 1031 exchanges, and many other factors.
For more information on today's program, visit re360radio.com. That's re360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit re360radio.com. That's re360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We're covering frequently asked questions today by real estate investors, especially newer investors and new and out of state. Frequently get people asking, I'm nervous about going out of state. What's your thought about that? Well, I'd say going out of state tends to give better return on investment, because when you get away from the coastal cities, you tend to get in areas that have not appreciated as much over time. What happens with time is that the real estate prices, no matter where you are, as long as you don't have rent control, or even without rent control, I should say, rents never keep up in proportion to house prices. So as time goes on, the ability for metro and products in that metro to continue to cash flow well are poor. So an example, a house in San Jose in 1970 was about $30,000. It would rent for $300. So that's a 1% ratio. That same house at the peak in 2006 was worth about $800,000, and it would rent for $2,000. So that's 0.25% rent ratio. So 1/4 as much rental income as the house was worth. So that's what happens. So how do you reset time? How do you go back and steal time that you might have missed out on? Well, you do that by going somewhere else. You know, we've had a drop here in Silicon Valley, and now it's recovered to about where it was, and you still have that 3-to-1 kind of disparity between the rent ratios. So you take, so what do? You take $800,000. Now that rent maybe is a little higher because the economic engine of Silicon Valley is doing pretty well, but the rents are like $2,500 for an $8,000 house. So that $800,000 house, you can go to a place like Dallas-Fort Worth, and you can buy 8 houses, $100,000 a piece, and they'll rent easily for $1,000 a piece, or $8,000. So that's not hard to figure, right? $8,000 versus $2,500 for $800,000 worth of real estate, and it's a better product, and you've broadened your base of your assets because you can buy them in different neighborhoods and so forth. So that's the reason for doing that. You know, people say I'm nervous about it not being here, but yet they buy stock all the time that's in other areas. They don't go and inspect the buildings or kick the mortar, or they don't go and interview the management. So to me, you have a lot more control in your out-of-state real estate than you do in a stock that you buy. And for the same reason that as you buy a company that's well managed, you also want to have a good manager for your real estate. So don't try to self-manage. That takes a lot of time, and that's time that could be spent trying to find better quality investments or investing more. So go invest where you get the best return, where you've got cities that are a broad-based economy and that they are going to have high probability of growth, both in jobs and in population, and that's what keeps driving rents up, and that's what keeps you on track for your retirement. So when we come back after the break, we're going to talk about other factors such as the loans for the products and managing it and so forth. So we're covering frequently asked questions today by the new investor or the new out-of-state investor. This is Tom Wilson with Real Estate 360, and we're on KDOW 1220 AM, the Wall Street Business Network. We'll be right back after the break.
For more information on today's program, visit re360radio.com. That's re360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit re360radio.com. That's re360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We're covering frequently asked questions by new investors and new out-of-state investors today. Here's one that came in from Juan in Marin County. It says, how will I earn good returns when the rent barely covers my mortgage payment? The answer is it won't. So indeed, your income has to be greater than your mortgage payment. In fact, it has to be greater than what your principal, interest, taxes, and insurance are, plus your property management fee, and that allows it to be net. So for some good examples, go to TomWilsonProperties.com and go click on current inventory, and go click on any one of those houses that are on there and open up the pie chart. The pie chart we have for every single property that we make available to investors shows what all of those different expenses are relative to the rent, so you can understand how those components work out and why you have to have rent that's quite a bit more than what the mortgage payment is in order for it to cash flow. So how much do I need to retire? Good question. In general, good products in good metros tend to these days return about 7 to 11% cash on cash return. That's from the experience of our clients and our own portfolio that we have of properties in Texas and in California. And if you so you just figure out how much you want to retire on. If you need $70,000 to $100,000 per year, and that's enough for you to retire on acceptable standard of living, then that says you need about $1 million worth of equity at work in rental properties. So one way you can do that is buy 10 properties, do 15% interest, or 15-year amortization loans. In 15 years, they're all paid off. You have them free and clear. You have $1 million worth of assets, and you should be getting something like $70,000 to $110,000 a year. And for those who can accept a retirement in 15 years, that's a very viable way to go about it, and that can work. What else can you do? Let's say, well, I don't like the 15-year amortization. Well, you can get more properties than your 10, and as they appreciate, you can sell off some of those, use that money to pay down your loans, or you can just keep the loans in place and make sure that your accumulated number of properties gives you the amount of monthly income that you want. So that's certainly a generalized good approach. One problem that we have today as investors is that we're limited by loans that are backed or sold to Fannie or Freddie, or Fannie specifically, because they are the only ones that are allowing 10 loans. So that restricts you to 10. So beyond that, you need to get a partner. You need to buy some with cash. You can go to your IRA or self-directed IRA, and you can buy some out of that. So there are different ways where you can go beyond that 10 number. Will it go back to more than 10 someday? I think with time it will, but it may take a while. But with 10 it can work, and you can certainly do equity partnerships with others and use your IRA and buy some with cash, and you can get more so that it will get to your end goal a little bit faster. If you're professionally employed and you have good professional income with you or you and your spouse, certainly it is rare that we cannot get loans for our investors, and that is generally not a problem. We had very few during the run-up. We had very few people who were qualifying for loans on stated income. Our typical client is a couple who both have professional incomes. They qualify very well for a loan. They've accumulated some money. They know they need to invest in something that earns more per year than what they're getting in their money market or other low interest paying investments, and they just haven't got the time to figure it out. So that's where a turnkey provider like Wilson Investment Properties comes in, as we provide that knowledge, experience, expertise. If I were going to, so that's certainly, no matter who you go to, certainly get yourself a reputable team, business that is doing this all the time, that has, you can do some blogging on them and find they have good records, good track records, that they are invested themselves in that area, that they're very selective on the products that they are getting, that they're mainstream. They aren't out in rural areas, they aren't in crime zones, that the products aren't too old, that they're in good condition, don't have maintenance problems or deferred maintenance problems, that they select good tenants. So it's hard to screen all of that. So you really you can network around, find out if you identify a provider, go network around and find out what their reputation is. Talk to clients who have bought from them, that sort of thing, because that's really what you need to try to walk into a town, find an agent who's really experienced in investment property, not just say they are because they sold a duplex last year to somebody, but are really experienced. Is very hard to find, nor is it make sense for them financially and time-wise to go spend the time that it takes to really find good quality products. You want somebody who's already in that business, as you would anything, any service or any product you want to get. You want someone who's already in that business, and that's the real estate investment business is a very unique and small portion of the total real estate arena of professionals. So that's a specialty, and if I were going to another city, I would certainly look up for experienced pros in that city too. We'll be back for a wrap-up in a minute. This is Tom Wilson, Real Estate 360, KDOW 1220 AM, and this is the Wall Street Business Network, and we're dealing with frequently asked questions by new investors.
For more information on today's program, visit re360radio.com. That's re360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit re360radio.com. That's re360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks for being with us today, addressing frequently asked questions by new investors. A good last one maybe is, what are the risks of investing in real estate? I'd say certainly investing in the wrong place at the wrong time with the wrong team. Wrong time, you don't want to be investing in properties that are about to go down. How do you tell? Well, you want to look at the number of foreclosures and the amount of negative equity that's in that neighborhood, because most of that negative debt has to be cleared out before it can significantly rise. Inward migration is a great indication of arenas or areas that go up and are continuing to go up. And I would say that the income levels and the affordability index is a good indicator of when things might start going down. Affordability index tells you what percent of the population can afford today's properties at today's interest rates. And when that number starts to get down in the teens, start to be careful. That's when things are about to go down again. And those are some of the important factors. So you want to get a team that's very experienced and knows that particular area very, very well. You want to go in metros that are growing and are projected to grow. You want broad economies. And I'd say if you put those all together, you have yourself the good basics for being on the road to putting together a retirement package that's going to work very well for you over the long term. And again, if you'd like some consultation on walking through some of this in more detail, answering more of your specific questions, please shoot an email to us or go to tomwilsonproperties.com and let us know that you would like to have a consultation. If you would like to have a weekly newsletter that tells you with a one-page read what's going on in the world of real estate relative to economics, that's free, and your name doesn't go anywhere else. That's a very, very nice way to keep up with what's happening both in the nation and in the local areas, and also it will give you some glimpses into what's going on in Texas, which is certainly no secret, one of our favorite places to invest. By the way, I never lived there or from there or anything else. As a technical person, I'm just very analytical, and as I continue to look at all of the data, that's still my favorite state and favorite set of cities to invest in. And if you want to get a report on how to go through this methodology of selecting the best metro, and how do you find the data and what sources you go to find the data to figure out which metros are growing the most, which ones have the broadest based economy, which ones have the best rent ratio, and so forth, that's a nice 19-page report with lots of graphs for all of you techies out there, analytically inclined, that will help you to work through that. And we welcome your questions, of course, at any time. Thanks for being with us on this segment where we've answered a lot of frequently asked questions for the new investor. Hope to have you back with us next week on Real Estate 360, the Wednesday edition. This is Tom Wilson on AM 1220 KDOW, the Wall Street Business Network. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit re360radio.com. That's re360radio.com. AM 1220 KDOW.